Dear investors, equity markets in India continue to experience volatility and strong FPI outflows. However, over the past period, they have broadly traded in a narrow range, tracking oil prices. And we have seen any sharp downtick of 5% or more attracting buying interest. The market seems to be sustaining in spite of wall of worry and digesting issues like high inflation, high oil prices, geopolitical uncertainty. On this, there is an addition of palm oil and vegetable oil increases, which will feed more into inflation. Policy response has been coming in. Tightening may be quicker, stronger than what was anticipated before. Fed should start reducing balance sheets by around $95 billion a month from May. It almost seems like the policy in West is now increasingly okay to slow down the economy to fight inflation. Here, I would say that India with high unemployment still is expected to see slower tightening in comparison to the West. The other issues are large LIC IPO, which is again expected over the month of May. Margin rule changes, which will come in from 2nd of May, Q4 and Q1 FY23 results, which are expected to be weak on margin squeeze. These are the major worries, and yet market is holding on. I think what is happening is that corporate India commentary for medium term is positive and is providing confidence to investors. While there is slowdown in profits and margins, it is seen as temporary. The overall medium term buoyancy seems to be sustainable. After a long while, corporate India has embarked on a Capex mode, and we believe this could get stronger as we go ahead. Aided, of course, by PLI incentives and improved capacity utilizations. The focus on Capex by corporate India is seen in government Capex spends also. We have seen that in the budget, they bumped up the focus on Capex. This could get stronger because government finances, government tax finances are stronger than budgeted numbers. Individual Capex today is also strong. Home buying, which is the largest part of individual Capex, is seeing strong traction. So now after 2003, this is probably the first time that all three engines of Capex have started to fire at the same time. Once started, this continues to propel growth for several years. And I do believe that over the next 10 years, we could see India deliver a CAGR in growth, which is higher than what we have seen over the past 15 years. While higher oil prices are negative, cheaper Russian crude is a source of higher margins for corporate India. Higher prices of other commodities may actually help India. We are large producers of metals, steel and aluminum. We are large producers of agri commodities such as wheat, millets, and sugar. Producers of these commodities should see incomes improve. While yes, higher fuel costs would impair the savings of middle class substantially and may lead to downtrading. I do believe that while people are thinking about downtrading to happen in one segment, they are forgetting about the fact that there is another segment and maybe larger, which would benefit because of higher agri prices. Once the agri produce gets cut, which is around the corner, the consumption patterns in rural India, tier 2 towns could get a boost and provide support. There are benefits which are coming in. Indian currency is expected to become more accepted globally. Make in India should get a policy fillip as risk of geopolitics is now very evident. Particularly in the defense space, I think we have already shared three lists of components platforms which need to be manufactured in India and not imported. Also, on many counts, the confidence of retail investors is high. They came at the bottom of the market, and now more and more of them are investing starting from a young age. There was an analysis of a large retail broker recently, and it seems that most of their new clients, the average age may be like 25, 26 years. The number of demat accounts have increased sharply, and MFs have seen continuous inflows. This should continue. White collar jobs are in plenty, and practically the whole batches out of colleges are getting absorbed. Wage increases are happening. Working from home is leading to larger than usual savings. This is providing confidence to the youth to come to the market, and we believe this could prove structural. We have seen this happen in markets like China and Thailand, and I believe we should start to see this happen in our country as well. The positivity is aided by growth-oriented policy making by the government and growth-supportive stance as yet of the RBI. Government has been very active in reforms which aid the industry. PLI benefits, zero import duties on cotton. This is very recent. Cotton prices started to move up. Government cut duties to zero. Ethanol policy, import duty protection wherever there is a hurt on the domestic industry. Higher indigenous production in defense, lowering of telecom 5G spectrum rates possibly. Retrospective taxation issues getting sorted, Air India privatization, FTAs with Australia and UAE, etc., are all things which have happened in quick succession and provide positivity. While there are stresses on the economy versus in the past, one point that I would want to make is that rupee has shown very good stability. This has happened while competing countries like Turkey, which competes in engineering, leather and textiles, Sri Lanka textiles and tea, Pakistan textiles and leather goods, for example, have seen sharp currency depreciation. Now, this has happened because our external front is becoming more balanced. At $75 per barrel oil, IT exports exceed oil imports. Even at $100 oil, the gap in trade and services exports and imports is nearly met by remittances, providing good stability to the INR. Stability of the INR does go to some extent in providing stability to the markets. Had INR been more volatile, secondary markets in India would have been even more volatile in these difficult times. Going forward, market should focus on the result season, which is started. Expect this to be weak, as would Q1 financial 23 be because of margin squeeze. However, large pockets such as banking, commodities, steel should deliver good results. IT companies should again deliver results as per expectations with strong commentary for the future. Corporate commentary is something to be watched. I do believe it should continue to be very positive. The benefit on account of higher agri produce should result in better buoyancy in tier 2 towns and villages. And this could reverse the recent weak trend that has been noticed there. It is increasingly clear that India would be allowed to source cheaper oil from Russia. There are reports that even Reliance is sourcing large cargoes from Russia. Cheaper oil would deliver better margins. or sales buoyancy, one of the two, for users as selling prices are linked to international parity prices. Better access to Russian market for pharmaceutical and tea, two of our large exports should also happen. FTAs with Australia and UAE and the possible one with UK expected by October should again result in export buoyancy over time. In terms of themes, we continue to favor on sustainable themes rather than look at spaces which are benefiting in the immediate future, because spaces like commodities, according to us, should correct sooner than later, and hence focusing on longer period sustaining themes is a better way of investing. Private sector lenders focused on retail is a space we are positive on. Beneficiaries of China plus one, which includes chemicals and API manufacturers. Beneficiaries of a strong move from unorganized to organized in spaces such as grocery retail, jewelry, garments, diagnostics, etc. Beneficiaries of move to internet, both service providers and platforms, are spaces that we believe could continue to do well. We would continue to be focused on consumer names, which we believe would benefit strongly from any fall in commodity prices. Something which could take place over the next 5 to 6 months, while the immediate future is very, very difficult for sure. Higher quality spaces, particularly names that delivered growth, did well in the last taper period. Okay, and could continue to do the same this time around as well. This is the part we are focused at. These are companies which have made new all-time highs with very high degree of regularity through, taper in the last period, demon that we experienced, banking sector issues, etc., taking into stride. All the headwinds that the market threw at them, I think these would again be the go-to for the coming period. Interestingly, while markets have moved, disjointed with earnings over a short period of time, over longer period, they have mostly moved in sync. It's almost lockstep. The increase in valuations is thus a result of changes in the index. The expensive part of the index was just about 12% and is now expanded to close to 50% over the last 15-20 years. Since the higher valuations are mostly on account of changes in the index, I do believe that the shorter term averages are more relevant, and the commentary about indexes being standard deviation or more higher than long period average is not a correct narrative. Working with 5 years average valuations for Nifty, which is 18.5x, and applying the same to Nifty earnings of around 1,000 for financial 24, we arrive at an index target of 18.5 from now to March 23. Here we have adjusted the multiples to account for larger share of profits coming in from lower PE spaces like commodities and PSU banks. A similar number is arrived at looking at bond yields and earnings yield. With strong earnings momentum in the future driven by lenders, commodities and IT, we do believe the direction of the market has a good probability of being positive, and that the other events would cause volatility but not change the overall direction of the market. This was seen in the past. A taper by Fed in 13 and beyond did cause volatility, but the direction of our markets was on account of our earnings and our policy making rather than what happened in other parts of the world, as it should be. We believe that with domestic money becoming a larger force in the domestic market, the influence of global events would reduce. Overall, I think we should expect lower than earning growth returns with heightened volatility in the market. Focus on quality should help going forward. Higher interest rates are bad for commodity prices and commodity stocks. Lower price Russian crude, whosoever is sourcing it, is good for profits. Financials and IT should continue to deliver strong number and have a good outlook. Chemical companies should benefit in the near term from supply disruptions elsewhere, while strong growth trajectory would continue over the medium to long term. Consumers would get impacted for sure by higher input prices and slowdown and down trading in consumption. Higher input prices of vegetable oil would hurt and would have to increase prices as we go forward. But over time, as commodities cool off, which we expect over the next 6 months to happen, they should come back. In some way, this is the contra trade in the market just now. Lastly, let me say that there is a heightened risk perception on account of high inflation, geopolitics, continued FPI selling, etc. Markets are where they are in spite of this. As it normalizes, for example, if oil falls by 20 odd dollars as it and starts to trade where it was before the geopolitics started. For example, if after sustained selling, which is the highest that the country has seen ever, FPIs reduce selling or stop selling, there is a great chance that as situation normalizes, there would be a relief rally. In terms of risk, higher inflation and stronger than anticipated policy response is a risk that clearly needs to be watched. However, at the same time, one needs to remember that higher inflation in the present period would imply low inflation over the next year on a very high base. We are working with 18.5 index target, 18,500 Nifty target, which would increase or decrease by 5 or 6% on, let's say, a $20 plus decrease or an increase in oil prices. Just trying to help listeners with how the outlook may change with movement of a very, very important variable. Thank you and happy investing.